So here we have a question from the June 2012 exam, and it is nominally a question about step acquisition as far as P2 is concerned, but there's lots of other fun and games that we have to deal with. As always, the first thing I would recommend that we do is set up our pro formas, add in an additional line for goodwill, add in an additional line for non-controlling interest, and make sure that we've got plenty of space. I really would recommend that the whole of a single side of paper. And personally, the way I always lay things out, because you've got your ACCA booklet, I would always lay it out whereby I've got the answer on the left-hand page and my first page of workings on the right-hand page, because it's just less things to flick through. So your first page in your ACCA booklet is a right-hand page. I always write a line through it and I then turn over. Okay, all of these, they just make slight differences, slight improvements, and the way that we're going to succeed is it's going to be 20 small improvements, not one eureka moment. And that's how we approach the exam, in my view. So having set out the pro formas, and I've set out my standard workings in advance just to save us a little bit of time, is we need to determine our group structure. So we've got Robby, and we've got our two investments, Hall and Zinc, and Robby is quite a dull subsidiary in the sense that we've simply got 80%, and as far as Zinc is concerned, it was originally a trade investment and we then bought a controlling interest, so we've got 60%. So therefore the NCI will have 20% and 40% respectively. Having determined that group structure and set up our net assets working, goodwill, NCI, and group reserves. And one thing, a word in advance, for this particular examiner, the reserves notes tend to be very, very complex. So I would leave a good half page for your reserves note, because they can turn out to be monsters. And I wouldn't ever add them up in the exam because there's so many adjustments to put through. But let's kick off, and the first thing that we see is our very good friends property, plant and equipment. And all I'm going to do is to say, well, let's add them up for our three group companies, and that comes to 198. Then we've got the investments in the subsidiaries. So I'm going to go to the goodwill calculation and say cost per the SFP. So we seem to have figures of 55 and 19, but more of that later. Then we've got financial assets, and I've not referenced the financial assets to anything. There don't appear to be any adjustments to the financial assets. So if you see that we don't think we're going to need an adjustment, you can always take a gamble. And I've added them up and got 29. The joint operation, what I'm going to do is a joint operation is not dissimilar to an associate, potentially. I'm going to set up a working for my joint operation. Per the statement of financial position, we've got a figure of 6. I'm not quite sure what to do with it at this stage. Then we come to current assets, and I've referenced the current assets to some of the notes, so I think that might need adjustment, so that's 24. We now turn our attention to share capital. The share capital of the parent is 25. So that goes directly onto the face of our statement of financial position. We then have the share capital of our two subsidiary companies, so to our net assets working. Share capital figures, and we need to do those for our two key dates. That's going to be at the SFP and the acquisition date, the SFP and the acquisition date. Share capital 20, 20, 10 and 10. We have other components of equity. Notice we only have this for the parent. So go to reserves, parent, we've got figures of 11 and 70 for retained earnings, and then we have retained earnings for our two subsidiaries of 27 and 19. At the SFP date. Non-current liabilities, I'm going to add those up. And I've seen some notes in relation to liabilities. I'm not quite sure what's going to need adjustments. I've got 94 here. And we've got current liabilities. Add those up, and again they seem to be referenced to some of the notes. So I've got a figure of 55. So we've therefore taken every single figure from the SFP, and it is in a potential mark earning position. Let's now start on the additional information. On the 1st of June, X1, we acquired 80% of Hale. The purchase consideration comprised cash of 50 million. Robby has treated the investment at fair value through OCI. And I'm thinking, well, hold on, I've got a figure of 55 million. So what I need to do is we need to adjust to cost, because goodwill arises at the date we achieve control. So I'm going to take 5 million off the cost of the investment to take it down to 50 million. So let's think of this in terms of debits and credits. We have credited cost of investment 5 million, or we've credited goodwill 5 million. So I've got to debit something. Where did we previously take that gain to? It says in the question we took that gain to OCI. So I'm now going to pop down to reserves and adjustment to the Hale cost from working number 3. I'm going to reduce OCI by 5. A dividend received from Hale on the 1st of January of 2 million has similarly been credited to OCI. I'm thinking, what were they smoking when they put through that journal? You know, it's crazy. It should be dividend to retained earnings. Yeah, dividends should go through to regular profits. So I'm going to take it out of OCI and into profits, into retained earnings. It's Robby's policy to measure the NCI at fair value, and this was 15 million at acquisition. So we go to NCI, and we can say that acquisition for Hale, it's 15 million, and that also goes into our goodwill calculation. NCI at acquisition, 15 million. On the 1st of June X1, the fair value of the net assets was 60. And we'll see, and you'll pick this up from the way that the examiner always tends to set out his questions in a similar manner. So the more questions we practice, the more familiar we'll become with the style of the examiner. We have here a fair value of 60 at the date of acquisition. And it says the retained earnings of Hale were 16. So slot that in. The difference was due to an increase in the value of land. So our fair value adjustment, these two together add up to 36. If I compare 36 to 60, my fair value adjustment in respect of land is 24. Credit reserves 24, debit land in PPE with 24. So those adjustments, all of that's F7, isn't it? But if we put through all of those items, we've picked up 4 or 5 marks. We're looking to get 18 marks in this part of the question, and it is a really tough question. B. On the 1st of June X0, Robby acquired 5% of zinc, and we've treated this at fair value through profit and loss. On the 1st of December, we acquired a further 50%, which gave us control. So it is at this date that we need to work out the net assets. The consideration for the acquisition was as follows. So the original shares cost us 2 million. The new shares cost us 16, so we've got a figure of 18. But it also says at the 1st of December X2, which is at the date we achieved control, the fair value of the shares of the original 5% was 5 million. So therefore the total cost that should be going into our equation is 21, because it's going to be the cost of the 5% is 5, and the cost of the 55% is 16. 5 plus 16 gives us 21. So if I go to my goodwill calculation, I've got a figure of 19. So my adjustment to cost is 2. So that's going to be 21 minus the 19. So I'm going to increase the cost of the investment to 21. So I'm debiting cost of investment by 2. And therefore I'm crediting. Now here we're treating this one at fair value through profit and loss. So no complications as such. Increase the cost for zinc from working 3 it's to retained earnings, because zinc is held at fair value through profit and loss. If you take a look, see what it says. Now the figure we've got of 19, the reason why there's a figure of 19 in the SFP and the cost is 18 is because we do revalue to fair value. We just didn't show the correct fair value at the date of acquisition. So therefore I'm going to increase that cost by 2, so I've got to debit cost of investment 2 and credit retained earnings with the 2. And that was really sneaky the way that that was laid out. It's Robby's policy to measure NCI at fair value, and this is 9 million. So I'm going to go to zinc and say we've got a figure of 9 million at acquisition, and that goes into our NCI calculation as well. The fair value of zinc's net assets at acquisition was 26. So up to here, and we can say we've got a figure of 26. And the retained earnings were 15. The excess of the fair value was due to an increase in the value of PPE. Now that's going to work out, balancing figure, 1 million. So I'm going to increase PPE by 1 million. Okay. Deal with each sentence in turn. Don't try to deal with all of this adjustment as a single journal is my advice. Break it down into bite-sized chunks. These values, however, this revaluation was provisional. Now under IFRS 3, you've got 12 months to finalise your valuations. And we had a final valuation on the 1st of March X3, which is within the 12-month period. And it's going to increase a further 3 million. So I'm going to increase PPE by a further 3 million, so that's going to increase my assets here, and I'm going to increase it, so I'm going to say fair value to increase the net assets at both the acquisition and the SFP date by 3 million. This increase does not affect the fair value of the NCI. That is a relief. PPE is to be depreciated over the remaining period of 5 years. Well, when did this acquisition take place? It took place on the 1st of December X2, so therefore we have owned the assets for 6 months since the date of acquisition. So I need to charge depreciation. The fair value adjustment, the 1 and 3 together, gives me 4. I'm going to write that off over 5 years, and in the current year I'm going to charge 6 months worth of depreciation. That gives me a depreciation figure between the acquisition date and the SFP date of 0.4. So therefore I'm going to debit reserves 0.4, reduce reserves, and reduce the asset value by 0.4 at the same time. I think this PPE note could be an entry in the Guinness Book of Records by the time we finish with it. Note C. Note C is something to do with the joint operation, and if you can't remember what to do with joint operations, you do absolutely nothing. You just leave it in at the figure of 6. Okay. Yeah. It's okay. So it's credit PPE and debit the reserves of the subsidiary. So, how do we go about treating a jointly controlled asset? Under IFRS 11, you simply take your share of the assets and liabilities of what's taken place. So per IFRS, we show our share of the assets, liabilities, etc. So the natural gas station cost 15 million to construct and was completed on the 1st of June X2 and is to be dismantled at the end of 10 years. The present value of the dismantling cost was 2 million. Well, this should be added to the cost of the asset. So what are we going to do? Is I'm going to debit PPE with our share, which is 40% of the 15, which is 6 million. I'm also going to debit PPE with our share of the dismantling cost, which is now going to be added to the cost of the asset. So that's going to be 0.8. What should we then be doing? Well, we should recognise the fact that we have a provision. So we should credit provisions 0.8 million as well. And I'm going to credit the joint operation 6 million, because we're going to take it out of joint operations and put it into PPE. It says we're using a discount rate of 5%. So what we have to do, we have to unwind the discount. So I'm going to debit the statement of profit and loss 5% of 0.8 million, which is 0.04, and credit the provision 0.04. And I'll put these all through the accounts as soon as I've finished all these journals. And this is just a vast journal crunching experience. It says that the gas station is to be dismantled at the end of 10 years. So we have to charge depreciation. So I'm going to debit statement of profit and loss. So this is for unwinding the discount. On the provision. I'm going to debit the statement of profit and loss with depreciation. When did the gas station kick off? It was on the 1st of June X2, so we've owned it for a full year. So therefore we're going to charge depreciation of 0.6. And we're going to credit PPE 0.6. Actually, it shouldn't be that. It should be charge depreciation of 6.8 million. Because we've debited PPE a total of 6.8, haven't we? So I'm going to charge depreciation of 0.68, and I'm going to credit PPE 0.68, which is depreciation on the total cost of the asset, including the amount that we've capitalized in relation to the provision. So that deals with that first note. In the second note, it says gas with a direct cost of 20 million was sold, and we've paid 16 million for that, including operating costs. And it says Robby has only contributed and accounted for its share of the construction costs. The revenue and costs are receivable and payable by the other joint operator, who settles amounts outstanding with Robby after the year end. So what we need to do is we are due to receive money in respect of the sale of the gas. So I'm going to debit receivables with our share, 40% of 20 million is 8 million. And I'm going to credit payables 40% of 16.5 million. It's going to be the 16 plus the operating costs. So that works out as 6.6. How much profit have we made? Well, the profit is going to be the 8 million less the 6.6 costs less the depreciation of 0.68 less the unwinding of the discount of 0.04, which works out as 0.68. Sorry? How many marks? 34. Yeah, 34. There will be, there would have been about 4 or 5 marks for this, but this is why I say to people, don't stress, because you could have actually done the whole of the rest of the question, completely ignored the joint operation, and you could have picked up, yeah, you could have picked up 18 out of 30 through doing everything else, couldn't you? Ultimately, it's just journals. It's just multiplying numbers by 40%, isn't it? That's all I've been doing. I've not been doing anything sophisticated apart from using my 0.4 button on my calculator. So let's work out what I'm going to go through this. I'm going to therefore increase PPE by 6.8. I'm going to tick that and tick that. I've got rid of the joint operation. For provisions, I've got 0.8 and 0.04. So I'm going to increase liabilities, non-current. So I'm going to put this in here. Yep. Yeah. Hold on. Are not sure balance? If you put all these through, that and that are shown there and there. Just give me a second and we'll work our way through. Okay. So in terms of the impact upon the statement of financial position, we've got provisions of 0.8 and 0.04. So provisions together come to 0.84, which is working number 6. Receivables have increased by 8. So that's current assets. Payables have increased by 6.6. And profit has increased by 0.68. So all I've done is that the reason why it doesn't balance as such is that this one and this one and this one and this one are all going to flow through into a single entry of 0.68, which goes into my group statement of profit or loss. So profit on joint operation from working number 6 is 0.68. It was fiendishly difficult, there's no doubt about that. So that's note C dealt with. Next we come to our PPE impairment. Don't stress. Nobody got this right. Nobody will ever get this right. I've got to show you because otherwise I'm not doing my job. But it's simply not important. Just try to work out. If you'd thrown in a few of those 40% and stuck those in your answer as the group share, you would have picked out 3 of the 4 marks. Now in terms of the PPE impairment, this is an asset which has been revalued. So we've got the original cost of the asset, which was 10 million. When did we buy the asset? It was the 1st of June X0. Now we revalued it in X2. So if I say depreciation to X2, that's going to be 2 years worth. How long was the asset life? It was 20 years times 10 million. So we would have depreciated it by 1 million, the carrying amount at the 31st of May X2. What then happens? We revalued it to 11 million. So I therefore have a revaluation surplus of 2 million. At the 31st of May, impairment indicators triggered an impairment review, and the recoverable amount was 7.8. The only accounting entry was to post the depreciation based on the revalued amount. So in terms of the depreciation, it's 11 million, and we now have 18 years remaining left of the asset. It was a 20-year asset, and we revalued it after 2 years. So that gives me a figure of 0.61. Now, the depreciation based on the historic cost would have been 0.5. So therefore, what would we have done? We would have transferred the excess of 0.11 million from the revaluation surplus to retained earnings. So I'm now going to go up to working number 5. Depreciation transfer from working number 7, OCE debit by 0.11, retained earnings credit 0.11. We now have to reflect the impairment. So the value of the asset in the accounts, what have we got here? We've got 1.89 in our revaluation surplus. The asset value is showing at 10.39. We impair it to 7.8. So therefore our impairment is 2.59 million. So I'm going to credit the asset with 2.59 million. So let's go up to the asset, go up to PPE. We charge the right amount of depreciation minus 2.59 from working number 7. What do we depreciate? Sorry, what do we impair first? You always impair first your revaluation surplus. So I'm going to reduce the revaluation surplus by 1.89, and therefore the other 0.7 will be impaired against profit or loss. And let's work out what's happening here. But if you do that, under the historic cost basis, the asset's at 7.8 and the asset is at 7.8. So my adjustment here is credit PPE 2.59, debit OCE, so we say impairment from working number 7. So I'm going to debit OCE 1.89 and debit retained earnings 0.70. That is an F7 adjustment. Note E, Robby held some trade receivables. So I've got a little note here for the factor for the receivables. With a carrying amount of 4 million, at that date it entered into a factor arrangement where it transfers the receivables in exchange for 3.6 million of cash. You can only de-recognise a financial asset if you no longer have the risks and rewards of ownership. What is the major risk in relation to receivables? Yeah, they're non-collectibles, they're bad debts. Now what does it say here? Robby's agreed to reimburse the factor for any shortfall between the amount collected and 3.6 million. So you see that Robby has the bad debt risk, so it cannot de-recognise those receivables. So we have to put those receivables back. So I'm going to debit the receivables 4 million. It said it charged 0.4 million to profit or loss. Well, I'm going to take that back to profit and loss, 0.4 million. and I'm going to treat the money from the factor as a loan. Because what is it? It falls within the IFRS 9 definition of a financial liability, because we have an obligation to transfer economic benefits to another party as a result of a past event. So plus 4 from working number 9 is added on to current assets. I go to current liabilities, and I'm going to add, it's a short-term loan, so that's come from, again, from working number, is that working number 8? I've lost track of my workings now. Yeah, that's working number 8. And if we go to reserves, factor 0.4 from working number 8. Note F. Immediately prior to the year end, Robby sold land to a third party for 16 million with an option to buy back in a couple of months' time. The market value of the land is 25 million and the carrying amount was 12 million. So we've got an option to buy back. Now, we can buy it back for 16 and it's worth 25. Are you going to buy it back? Yes. So this is a classic example of window dressing, isn't it? And we're not allowed to window dress. So this is a window dressing transaction. And so should be reversed. So it says the carrying amount of the asset was 12 million, so I'm going to debit PPE 12 million. We received 16 million from the third party. Well, we're going to repay that to them in a couple of months. It falls within the definition of a financial liability. We know we've got an effective obligation. So I'm going to credit liability 16 million. And when we sold the asset, we recognised a profit of 4 million on the sale. Well, we haven't passed on the risks and rewards of ownership because we know we're going to buy it back. So therefore I'm going to reverse that profit. So debit the statement of profit or loss, which flows through, of course, to retained earnings, with 4 million. So let's reflect that in our accounts. Plus 12 million from working number 9 for PPE. Plus 16 million for current liabilities for working number 9 in respect of the loan. And reduce profits by 4 million from working number 9 profit on land. And I'll put the word sale in inverted brackets. We've now dealt with all of the information in the question, so the next step is to consolidate. So now we're going to use our consolidation basics. So if we go to the net assets working, the net assets at the SFP date of Hale are 71. So since acquisition, they've increased by 11. If we take a look at zinc, at the SFP date, sorry, the acquisition date, they're 29. At the current date, 32.6 plus 3.6. Goodwill arises at acquisition. So here we go less net assets at acquisition 60 and 29. And this gives us goodwill figures yep. Sorry? Because the dividends have been paid out of retained earnings, so they're already been adjusted for in the books of the subsidiary. In the books of the parent, they've been incorrectly allocated.
No, what I mean is, this is a dividend paying from one company into the same company.
No, it's from a subsidiary to a parent. So therefore it comes out of, so it's out of the retained earnings. Whenever you see a retained earnings figure for a subsidiary company, that's after paying dividends. Because retained earnings is opening profit plus profit for the year less dividends. So it's automatically adjusted for. You're trying to adjust it twice, which is a dangerous thing to do. The issue is that in the books of the parent, it should have been, normally it simply had been credited to retained earnings and nothing else would have happened. And you wouldn't have even noticed it. The issue the examiner raised here was that it had been incorrectly credited to OCI rather than retained earnings. So we can work out our goodwill figures here of 5 and 1 and add those two together, and that gives us a total of 6. Now, I don't normally advocate this, but in this question, the way that the examiner had written the question, there was a case for actually working out the goodwill figures, because there were no further but once you'd done your fair value adjustments, for working out the goodwill and picking up the goodwill marks. The reason why students struggled with this question is that they got bogged down with the joint operation. And my advice for the joint operation would be ignore it and get 31 out of 35. So 6 from working number 3. We've got the non-controlling interest at acquisition. Since acquisition, we're going to give them 20% of H's profits, which are 11. So that's 2.2. And we're going to give the other 80% of the profits to the group. So we go to group reserves. Share of H, 80% times 11 is 8.8. For zinc, since acquisition, the NCI are going to have 40% of 3.6. And that gives us a figure of 1.44. And we give the other 60% to the group. Share of Z, 60% times 11, sorry, 60% of 3.6 is 2.16. So we can now work out our totals, if you have time. So for the NCI, 17.2 plus 10.44 equals 27.64. For retained earnings, an OCE, OCE somehow works out as 2 exactly, after all of those adjustments we put through. And if we do retained earnings, 74, retained earnings works out as 81.45. So let's add those in. OCE is 2 from working 5. Retained earnings is 81.45 from working 5. Non-current liabilities, no adjustment required. Current liabilities, quite a few adjustments. If we add up those adjustments, that comes to 81.2. And my SFP adds up, and this is what I don't want you to be doing in the exam, by the way, adds up to 312.13. 2 reasons. A, there's no marks for it, and B, it ain't going to add up to the right number. We go to our assets. Our joint operation, we ended up at 0 because you put the individual assets in. So current assets, 36. As I said, PPE, a huge number of adjustments to put through, but if you do put those all through correctly, 241.13, and we now add up our assets, 312.13, and we balance. Now, if you had done the whole question and ignored the joint operation, it would have simply balanced to a slightly different figure. Okay, these are difficult questions.